Hi, sisters and friends and bookkeeping mamas. It's Trevonna Parker here. I'm a bookkeeping mama and your bookkeeping advocate. I am here to help us all take the components of bookkeeping to help us be better at our financial literacy and also just lifestyle bookkeeping, where we take our life, match it up with the transactions that we have inside, and help us to reach our goals. My goal is to help you to avoid generational paycheck to paycheck living, or worse, generational poverty, by helping your family to protect your family, to nix your mortgage, defeat your debt, tame your taxes, make more, and live free. Now, on the bookkeeping journey, I want to talk about commingling. Now, if you guys are not familiar with commingling is just a mixture of funds. Another definition of commingling is to blend thoroughly into a harmonious whole. And although the one definition of mixing funds is generally what we're talking about, I did want to kind of point out that harmonious whole thing because it serves the same purpose, and it really kind of gives a picture of why it's important to avoid commingling at all costs when you start up a business. Now, the reason this topic came up was because as a bookkeeper, I went around and I asked some of my sisters in Christ who have businesses, what is it about bookkeeping that you would want to know more about? And one of the topics was commingling. I did want to talk about it because it is very serious on one end, and on one end it's not. So for example, when you first start a business, you may be a sole proprietor, you might do an LLC, but ultimately you have a stage where you're getting things together. And so you may have funds that are personal funds and also business funds. And some people panic behind this, but let me assure you that that is totally okay. It's important to know that the IRS doesn't necessarily care about how your funds are broken up. They care about your books and making sure that you are not taking any illegitimate business deductions. So this is why it's extremely important for you to either be really good at your books or to hire a bookkeeper, preferably an outsourced bookkeeper if you're looking to save money, along with the time and energy that you save by not doing your own books. Now, having said that, the IRS does not care, and that's where, when I broke it down, I said there are two ways. One end it's important, and one end it's not. So the IRS doesn't care about how your funds are broken down. They don't care whether or not you're using your personal account, your business account, whatever account you're using. They just need to know that you are keeping records of what you're doing. So before I go into any more detail about the or explain further, I have to take a step back and explain two very important financial statements. One, I'm sorry, I have a frog in my throat, please forgive me. One being the profit and loss, which basically is your revenue, or it's also called an income statement, but it's your revenue minus your expenses, which will give you your net income. If your net is a profit, or it's a positive, or in the black, it's a profit. If it's negative or in the red, it's a loss, hence the name profit and loss. Now, the other financial statement, the profit and loss is like a little video. So it gives you a starting point and an ending point and gives you all the details of what happened at that time. The other sheet is the other financial report is a balance sheet. The balance sheet is like a little snapshot. It gives you a picture of what's happening at this exact moment in time. And it will let you know that famous accounting equation, assets equal liability plus owner's equity. And in that, your assets are the things that you own, your liabilities and your equity are the things that you owe, or the assets are the uses of funds, your equity and your liabilities are your sources of funds. So in that balance sheet, way at the bottom in the equity section, you're gonna find some other things. You're gonna find something called contributions, and you're gonna find something called distributions. Contributions are things that you are putting into your business. Distributions are things that you take out of your business for your own personal use. And that's totally fine, totally okay. The IRS is totally okay with that. So how does this connect to what we're talking about, commingling? I'm trying to make sure that you guys are not panicking or overly concerned anytime you have an issue where your accounts may mix. So the first thing is, yes, please do get separate accounts. You want a business account and you want a personal account. They should not mix. It makes things easier for you to manage your business. Now, what happens if they accidentally mix? So for example, you are out and you need a business purchase and you only have your personal account charge card with you. And so you put it on your personal charge card. Or perhaps you're out and you're making a personal purchase and you accidentally swipe your business card and you didn't realize that until too late. It happens. What if you set some systems up in your business and you accidentally had them set up to your personal account as opposed to your business account? And so someone comes in and they make a payment to you and something happens. It happens. It's totally fine. The IRS is not going to hunt you down, fight you either way. The only time they have an issue is if those books and that tax return do not adequately and accurately reflect your actual business deductions. If you take illegitimate business deductions with the IRS, that's when they care. So what do you do at those times? Well, if you use your business account to pay for a personal charge, you just write that into your books as a distribution. You took out some personal benefit from your business. That's a distribution. If you actually use your business account to pay for, if you use your personal account to pay for business things, then you can go ahead and say, well, I have obviously given myself a loan. I've given myself a loan, and therefore now I have to pay myself this money back. Or you can count that as an expense to yourself. Now you become a person that payment back to yourself becomes an expense to yourself. So basically what I'm trying to say is, yes, you want to avoid commingling your funds. However, if the funds get commingled, it's not a state of panic, as long as it's accurately reflected in the books. So let me just break that down again, just in case I was too wordy. If you use your business account to pay for personal things, then you just go ahead and when you categorize that in your books, it becomes a distribution, something that you took out of your business for personal reasons. If you use your personal card to pay for business expenses, you then just pay yourself back as an expense with great detailed information. If you count that as a loan to yourself, then you'll put that as a loan to yourself and then pay yourself back as paying debt or liabilities. And that's pretty much it. That's why it's important to have your books in order. And that's why when I tell you guys that you should consider being a bookkeeper, bookkeepers are essential to businesses. So there's no shortage of a need for bookkeepers. So consider it and ask any questions. If you guys have anything any questions concerning this video, any questions concerning bookkeeping, leave that information in the comments. Also, if you do like the video and the content, please like the video, subscribe to the channel, and hit the notification bell so that you are alerted every time I say that, so that you are alerted whenever I upload a video. That's pretty much all I have. Until next time, you guys, remember, we're here to protect our families, nix our mortgages, defeat our debt, tame our taxes, make more, and live free, all while still glorifying Christ. It can be done. Keep your money safe and keep your soul safe. You guys have a great day. God bless you.